I'm joined here by John Frankel, who is a partner at FF Venture Capital, a startup funder based in New York. John, it's great to meet you. I'm glad we finally got there through the tech hurdle to now being recorded with one another.
As I said earlier, as we're trying to work out how to get Zoom and all this other stuff to work, I felt like I had the collective intelligence of 6 morons here.
You and I both. Well, I think out of the 2 of us on this call, I think we'll take that torch way before you do. But no, it's great. It's great to meet you. And obviously the purpose behind us getting together for this conversation is to try and educate some of the followers that Rekall Consulting has, which is near 30,000, a lot of which are in the startup community. And what we're seeing at the moment is a lot of noise in the tech space, as I'm sure you're well aware, around tech slowdowns and around people holding back and VC funding becoming a little harder to get hold of. And I thought, who better than yourself to talk to, with a portfolio such as yours and the kind of investments that you've been exposed to over your career, I suppose. It would probably be a good bit of insight that you and I could share. So I thought I would just, ask with a very leading question on your thoughts and your kind of observations in that startup community. Is it more difficult for people to get funding at the moment? Are the hoops becoming harder to jump through?
So I'm going to answer that question. I can give you just a little bit of background first to give you a sense of where the answer is coming from. So I've invested in startups since late '99, so about 23 years, and founded FF Venture Capital 14 years ago. We have offices in New York and Warsaw. We tend to be very early stage funders of founders. So it can be pre-revenue, early revenue. We look at probably 3,000 companies a year, and we maybe invest in 10.
Wow.
So we say no a lot.
Yeah.
We office in New York, office in Warsaw, fund in the US, fund in Poland. And we're looking to build that out over time. We have about 18 people on staff. So we're sort of, FF stands for founder friendly, but we're incredibly engaged with what we do. So let's just start with some stats, right? Not every company that wants to be seed funded is seed funded. And I suspect it's about 3,000 companies a year. I think over the last couple of years, probably a little bit more. But think of it in this way: for every 100 companies that raises a seed round, on average in the industry, 30 raise a Series A, 10 raise a Series B, 1 goes public. Maybe 16 get acquired. So, we're not using the term at the moment. A few years ago, we used to talk about the Series A crunch and Series B crunch. There's always a crunch.
Yep.
There's always the majority of companies each stage that don't make it to the next stage. And we looked at this and we said, well, if we intervene and help companies in a certain way, could we change those stats? So the stats are 100 going to 30 at A and 10 at B. In our portfolio, we've got 14 years of data, 75 raise an A and 50 raise a B. So survivorship Series B is about 5 times the average in the industry.
Wow, okay.
Another way to cut the data is it's estimated that of companies formed in a given year, about 4 basis points at any point in their life get to 100 million revenue run rate.
Right.
It's also estimated that about 1% of SaaS companies get to 100 million revenue run rate.
Right.
So, if you assume that gives you a sense of the drop off from every company to seed company. Within our portfolio, about 10% of our companies get to 100 million revenue run rate.
Wow.
So we're running about 10 times the average there. And so we have high survivorship. We're in year 14. I think we need a couple more years to prove this out. We definitely have, a small stable of centaurs and unicorns and the like.
Mm-hmm.
But we look at real numbers and revenue growth and business models, and I'll touch on that later. So your question is it harder now? It's always hard. I spoke to the CEO of one of our portfolio companies that exited last year, and we were catching up for lunch. And I said, remind me how long it took you to raise your round? He said, 18 months. So that's kind of what you deal with. It just, you got to kiss a lot of frogs. You got to step up. And just because someone says no doesn't mean they're right. Mm. We're often wrong. There are many companies we pass on that don't fit our model. We go on to be big companies.
Yeah.
The anti-portfolio is strong. We focus on what's in the portfolio and helping those companies get there.
What would you say then, with that in mind, are they really the key things that you look for when you're assessing, a company that's coming for its very first, bit of funding, whether it is seeded or what that might look like? Because I've been working with a few startups who are just starting to dip their toe and start to look for VC funding, but they've never done it before. And the pitch deck has come back with a bit of feedback to say, well, you're not demonstrating why you need funding, or there may be some feedback in there that they were not aware of. But what do you see the common pitfalls, or perhaps a better question would be, your advice to somebody putting a pitch deck together? What are the first kind of key principles you would want to see?
Well, there's a number of different questions in there. So let's talk about our filter. We like to invest in companies that do well whether the economy expands or contracts. Mm-hmm. So the growth drivers behind the companies for us are secular and not cyclical. And that drives us to certain sectors. So, today we like drones, robotics, fintech, and the application of AI mm-hmm. within enterprises, because we think those are secular growth drivers independent of the economy. Second thing we like are business leaders that we think are folks we want to work with the next 7 to 10 years, and that they want to work with us. That there's not necessarily completing each other's sentences, but there's an element of that. That there's an alignment there. We like companies with business models, not just ones that gather eyeballs. Not that the ones that gather eyeballs in the early years can't be great. It's just for us and our risk profile and coming at the seed stage, we like ones that can get to a business model early. Mm-hmm. We generally like businesses that aren't that capital intensive. And we like businesses with massive and addressable markets. Our best performing company in terms of contribution market cap is a company called Secure, mm-hmm. where we led a seed round at a 6 million valuation, and recently valued at a 5 billion valuation.
Okay, wow,
that's pretty good. But I look at the company and I can see a pathway, an aggressive pathway, but a pathway for them to get to 10 billion in revenue. 10 billion revenue could be $100 billion company. That'd be nice.
Yep.
We're already up 150 times on our money. It'd be nice to be up, 20 times that. From
that's why you're in the game. That's why you're in it.
But so we're looking for massive addressable markets.
Yeah.
And the last thing we're looking for are companies that are high margin. We like high margin businesses because that tends to go hand in hand with not being capital intensive.
Yeah,
and right. The problem for us with capital intensity is it dilutes us, so the outcome has to be even bigger if they have to raise more capital getting there.
Yeah. And
so I hope that helps sort of frame generally what we're looking for. But then you ask the second question. And the second question is, what should be in the pitch deck? So think about this. Most founders are so in the weeds, they can't tell the story.
Yeah.
So the pitch deck is the articulation of a story. We like a PDF. We like it in 15 pages, plus or minus. We like the pages numbered. Mm-hmm. And there should be a story arc. As you read the deck, it tells a story and simply communicates what the company does. I tell you, there's so many founders out there who cannot, in a simple sentence, explain what they do. other than it's A for B. I hate the A for B. Actually, I think there's a website called It's A for B, where it's Uber for strippers, or it's it's TikTok for retirees, or whatever. It's like they flip the two things. But the It's A for B is not an articulation of what your company does.
Yeah, and I think some of the feedback that I had is that some of the pitch decks, they told perhaps too much of a story and didn't perhaps bring to life the reasons why there was the need for VC funding. Do you think
people are storytelling, story-consuming creatures? We pattern match.
Yeah.
So tiger in the grass and all that kind of stuff. We love stories. I just tell the story, simplify, and it takes time, and that's why the process of putting a pitch deck together can really help this.
Yeah.
It really helps articulate someone who isn't in the weeds what it's about. Now, remember, we get, 50, 80, sometimes more decks a week to review.
Yeah.
So you're trying to communicate someone with the attention span of a 4-year-old. Quickly and eloquently what you're doing. And if you can't do that, it doesn't mean it's a bad business, but it makes it more difficult.
And is this on the framework that you've mentioned to me prior to us recording about your incubator growth program?
Well, our incubator.
Yeah, you mentioned about the framework that you have where people can subscribe to it, and effectively has almost like a paint by numbers, step-by-step guide to.
Okay, so we have 89 portfolio companies, one of which is a company called Founder Suite.
Yes, Founder Suite.
Foundersuite.com, and it's a SaaS platform for founders, and it helps them raise capital.
Right.
So it's all of the tools. It's a Trello-like board where you can see contacts of different VC firms and the like. So I mean, I would recommend that people use it because, like any other SaaS platform, it has tens of years, maybe more, of embedded knowledge on how to do something put in. And that's just one of the tools they do, which is the fundraising side.
Yeah.
Also deal with communications and the like. It's a really good SaaS platform for founders.
Yeah, wonderful. That'd be quite interesting to have a talk to those guys as well. Actually, I think that could be quite useful for future podcasts for us.
Nathan would love to chat with you. He's got lots of stories.
Yeah, that would be great. And what I've seen the last 2 years, because Rekall now, we've just gone through our second birthday as a startup, and we bootstrapped. Coming out the back of a pandemic to start up a recruitment company bootstrapping has been quite stressful. My beard has gone a touch more grey and my hairline a little further back, but we've helped some great startups now, and we've seen some great VC investments, some insane valuations. Some of the valuations that I've seen of companies has been quite interesting to see how they come to such a valuation, which brings me to the question, when you're valuing your people in your portfolio, how are you developing those metrics? How, what actually goes into this equation where you at the end of it get this figure?
So there's an asymmetry here in that I talk to 10 founders a week looking at their business model and the like, and other partners and folks our team do similarly. So we have a good sense of where valuations are.
Yeah.
Whereas a founder doesn't really, other than what they hear anecdotally. At the seed stage, it really is about option value. And from our perspective, we're very disciplined about the valuations we get in. And the last couple years has been an ill-disciplined environment. You said some crazy valuations.
Yeah.
And then with the public markets coming in and that bleeding through to the growth stage, it's turned out the people who are most vocal about VCs getting more disciplined are the ones who were ill-disciplined previously. If you're really good at VC, maybe you return your LPs 3 times their money.
Right.
So if you give up a whole turn or 2 turns on that first round, you come in at a 30 million pre or 40 million pre, as opposed to what should be a 5 million pre. it's going to be very difficult to do that, to
Yeah.
return 3 times. 3 times is a top decile return for VC. So it's kind of like people don't think of it that way. They don't understand the numbers. But let's say you have a great company, you put 5 million in and it's worth 100 million.
Yeah.
Now let's say you weren't disciplined, you came in at twice the valuation than that. Then you put 5 million in, it's now only worth 50 million. Rather than making 95, you made 45. Now that sounds great, but it's part of the portfolio where a lot of things you put 5 million in and they go to 0.
Right.
And so there's this discipline of really understanding how dilution works later and entry points. So that's the VC side. For the founder side, they should only work with people they enjoy spending time with. I mean, this is, I've said this before, the average investment we make lasts longer than the average marriage in the US. and it's harder to get out of. Yeah. So you should really reference the people you want to work with.
Yeah.
And for us, our value proposition is very simple. If we're on your cap table, on average, you're 5 times more likely to get to the Series B than if we're not. That's a very simple stat. But it comes out in reference because it's not just a magical, it just doesn't just happen. It happens because of all the hard work the team at FFBC puts in and everything else we bring to the table. And so when you reference, you talk to founders and they start saying things like, yeah, we wouldn't be here if it wasn't for, that's, it's better to hear from them than us say that, we're really good at what we do. Go and talk to any of our founders.
Yeah.
So, not everybody loves us, but we generally reference very well.
And how much of an impact does the reputation, does the background, the resume, if you will, of a founder play in that equation? Because one of the case examples that I have is we worked with an organization from Israel, and at the time they raised about $350 million in funding, and they probably had 10 to 20 million of recurring revenue. And a lot of people in the market were saying it's overpriced. How the hell have they managed to get such valuation and raise that amount of capital with such ARR? And the founding team were extremely well regarded. We're talking pretty serious players in the tech community. Does that have an impact?
Yes, it absolutely does have an impact, because ultimately you're resolving for probability of success.
Right.
And when you back a team, just as you back a VC firm, you're looking at all of those micro decisions going to be made from first investment to exit, making sure those decisions are made. And if you have a team that you believe will make those decisions well, that's a de-risking aspect.
Right. Okay.
And so, it factors in.
Yeah.
It does factor in, but sometimes it gets over-indexed, and you have to really think about whether you want to do that or not. And it's judgment calls. In the early, as you get to later stages, it's much more quantitative. Yeah. The earlier stage is much more qualitative.
Right.
A lot of judgment that is tough to put in a box. I like to say there's like 12 things we like to see, but every company fails on 4.
Right. Okay. And I suppose the tech is probably quite high up that list of numbers that gets checked. It's got to be
yes and no. There's companies we found in where the tech was basically a spreadsheet, but by the time they're raising their round of the 200 million valuation, they're on the 4th generation of highly scalable, tech architecture.
Right.
So the tech, when we invest initially, is never the tech when the company exits if it's successful.
Right.
Now, the approach, the methodology that's embedded in that is something you want to understand. But I think technical diligence early on is tough. That being said, we do, and you'll hear this from a lot of VCs, we like to see a technical co-founder. We like to see the ability to build the tech in-house. But tech diligence itself, we haven't seen that being a strong signal one way or another.
Right. Okay. And do you typically target for your investment dev first kind of startups? What's the kind of demographic of companies that you try and bring on?
So we don't really target, we listen.
Right.
The more you put blinkers on yourself, the less you're going to see.
Mm-hmm.
And we have to be open. There are whole new problems being solved in new ways. And if you just bring your past biases to it, I was talking to a founder today. I think it's really intriguing what they're doing, but they're targeting small and medium-sized businesses. And I generally hate companies target small and medium-sized businesses, but I like what they were doing. We had a good call, and we'll see if we move forward or not with them. But it's past biases are the biggest problem,
right,
in this industry. Patent formation is both an asset and a liability to VCs, and so you have to challenge yourself. You know, I sometimes find the things you think would appeal to people in their 20s and 30s, and we do blind voting across our whole team. We have 10 plus investment professionals, so we can get many votes on something. Sometimes I'm the only vote, and I'm like one of the old guys in the room, and I'm like, okay, I thought someone younger would like this, but you know what? So
that's the beauty of a panel, I suppose.
Yeah. So I think fighting against biases is really important.
Yeah, and I think culturally as well, from what I've seen in the last few years of recruitment in the startup community has been about overcoming biases. It's been heavily focused on, diverse and inclusive hiring, overcoming biases on every platform from a funding perspective and a hiring perspective alike. We've done quite a lot of work internally on creating like D&I frameworks for companies to make sure that they've got good practices from day one. Some of these stealth companies that we've been working with, we've kind of put something in there from day one, as opposed to getting 6, 12, 18 months down the line when somebody's just hired all of their friends and they're just a community full of men in a company, for example. It's been quite well adopted, honestly. I'm not sure how you've seen that amongst your portfolio, whether that has been a big initiative, whether it's just get the product built, get the product to market.
It's generally the first and the latter until they reach a certain size. And the reason being, it's hard enough building a company. We've got rid of zip code as an issue. Yeah. And what I mean by that is it used to be hire the best person in my zip code. That's just hire the best person. Yeah. So most of our companies really don't care that much about geography of where they're hiring now. But if you're looking for, I don't know, a really talented machine learning engineer to be able to tackle this problem in e-commerce, you're already down to that's just difficult to find. If you start putting other criteria around it, that can be tough. But I think our company is generally open that when you look at the candidate pool that comes up, to give diverse candidates a fair hearing and listen to them. So I think that's tough. And then the ones that are successful then have to spend a couple of years addressing the diversity optionality. But the diversity aspect gets solved in a way where the company is bigger, larger, and pay more salaries, and where that talent can be more evident because they're hiring 10 people into a role. Yeah. And so, they're just drawing from a larger pool. Yeah. But I think when they just get going, it's really tough.
It is tough, and I think I suppose the principles that I try and put in place is to have the right practices and procedures and the way of presenting, oneself as a business in the right way. Because what I have found is, it's a lot more challenging when you get a few years down the line. I had a large clients previously who just thought a recruitment company were the silver bullet to making more inclusive hires, and they said, right, now every shortlist has to have X candidates involved. And I was like, well, it doesn't really work like that. You have to have internal policies and procedures to actually attract these people to your business in the first place. And I think it's just a little bit easier if people put that framework in play a little earlier in their life cycle as a business, whether they do or don't make those.
I think people are sensitive to it. And some of our companies are very sensitive from the get-go. But I think there's a large number of companies out there who go like, on average, I only have a 10% chance to get to a Series B.
Yeah.
Right? I just can't be putting other constraints around trying to build this. And others go, no, this is important from the get-go.
Yeah.
But either way, I think people have a positive bias that if there is a diverse candidate, to find a way to accommodate them.
Yeah. It's been an interesting journey that I've seen over the last few years. I've seen a lot of kind of new industries pop up in that space in its own right. And I think, like you say, the startup communities is fraught with landmines and and high jumps and problems to overcome. And I think from what I find the most the most interesting about working with startups is just the general kind of nature of the people within it. Everybody's kind of very driven. I always use like a bit of an analogy, whereas startup people are typically like the Marines. You send them in, you've got an outcome, perhaps you've got limited kind of resources, perhaps, and a limited kind of structure to it, but you just send them in and they go make it happen. You send the military in next, because they can build on top of infrastructure, and then you send the police in after to kind of police what's being built. And I use that framework when I'm hiring for startups. I say, okay, what are you looking for here? Are you looking for the Marines to come in? Are you looking for the police to come in, to create what a infrastructure and what has been created, or the army to help build the infrastructure? It's an interesting hiring landscape. I'm not sure how much access you get to the actual hiring in your portfolio, but how challenging have you found it the last kind of couple of years?
So the strange thing about venture capital and being a venture capitalist is capitalism is in the name. And we're in an environment where there's a lot of creative destruction. Company goes and raises money, hires a bunch of talented people, trips over shoelaces and goes bankrupt. All those people then get hired by another company. And over time, the companies with a successful business model attract the best talent, and the ones that don't at least bring people into the startup community. So I think generally, yes, it was tighter a year ago than it is now. And let's roll the clock back to May 2020, and every company's like deer caught in the headlights, PPP, how to deal with that, who should we fire, etc. I mean, we went through all of that. Turned out, certainly with our portfolio, because we invest in companies which are not cyclical, like Q2 21, when the economy cratered, our portfolio companies actually grew revenues 30% year over year on average.
Yeah, nice.
So, this non-cyclical dynamic of growth that we like. And our companies raised a ton of money at the end of last year. Like, they raised as much money in 2021 as they raised in 2018 and 19 in aggregate.
Wow.
So our company, now listen, we got 89 companies, some did, some didn't, but just generally, a lot of capital. And what we saw was a reacceleration of growth and taking up a burn to do that. We then hit a wall between mid-May and mid-July. Almost every company put on the brakes.
Yeah.
Some cut some people, some stopped hiring, some was more selective, trimmed expenses, did whatever they did. And they took down their growth targets from, say, 100 to 120% to 70 to 100%. So still heady growth, but less.
Yeah.
And they still continue to grow, but suddenly their cost bases were less. And they changed their objective to, we'll raise around next year to will just get to profitability because they raised a lot of money.
Mm-hmm.
So I think that's what you're seeing in the startup community. You're seeing a lot of companies that were ready to go public that are not going to go public right now. This has been the worst year, I think, in 20 years for IPOs. I think that in the interim, the strong are getting stronger. The secular growth, the real companies within there are doing well. The ones that didn't get their capital raising cadence right are in trouble. But the ones that did, they're just like, okay, we're not going to raise that chunky round pre-IPO Q1 next year. We're just going to, get to profitability in Q3 and take it from there. In the interim, VCs are sitting on a lot of money. Even though they decided to sit on their hands for the last 6 months, they're sitting on a lot of money. And I think what will happen is these companies on the path to profitability will get interrupted with another round of financing that they weren't particularly looking for, but suddenly becomes available because ultimately the VCs have to deploy the money they're sitting on. And I think we'll be back into a growth spurt. And I think as we get into Q2 next year, I think you'll start seeing the IPO pipeline open. Obviously depends on the public markets. But I hope by Q2 next year, we will have put in a sustained bottoming back into a bull market. If not, then, delay it until that happens. But in the interim, if the company's growing and it's throwing off cash flow, it can wait.
Well, I suppose it's better than being in the bank with interest rates as they are at the moment. So if you can get it spent.
No, to be quite honest, you have to start thinking about the treasury side. Now that you actually can earn 2-3% on your money, you now need to be thinking about that.
Yeah, for sure. I think it's going to be an interesting run up to the end of the year. And from what I'm seeing and hearing, I think a lot of people are holding on and trying to, like you say, maintain profitability and get into Q1, Q2 next year, where people are anticipating, a little bit more market movement, which would be great. And
to be clear, if you're a good company and you've got a compelling value proposition, go and raise money now. It's not like VCs are not investing. It's not like we're not investing. We continue to invest. Other VCs are as well. But like, the 10 on 50 million pre off of a deck and, 2 weeks into a business is less likely to get done now.
And I guess from my perspective, if I can, bring this message to my community of, I've got a huge following in Israel, for example, in the founder community within tech. If I can give them a message, I guess that this video, this chat between you and I will bring them. What would that message be? What would you want to say to those people?
It's always tough. If it was easy, everybody would be doing it. And if you've really got a great business, just go out and do it. It's kind of like the number. If you're the kind of person where people say, well, it's a little tough out there, maybe you should wait, etc., then maybe you're in the wrong line. Maybe in the wrong business. This is the business of putting your neck out there and saying, hey, I'm going to will this into happening. I kind of believe founders are not reasonable people. The reasonable people in this world throughout history, delightful people. They just achieve nothing. The unreasonable people who have this belief they can suddenly make 10,000, 100,000, million, 10 million people do something different than they did before, they have to will it into action. And sometimes they're pleasant, but more often than not,
it's hard to deal with.
Steve Jobs was not a pleasant person from all accounts, but he was incredibly unreasonable.
That's what my wife tells me.
Has achieved, quite a bit for the greater good. He left his mark. And so I think, it is the unreasonable people with a drive to bringing something into existence. That tend to get stuff done in the world.
And if there's a way that these unreasonable people with an idea, with, you know, they've got a dream, they've got a technology that they're building and creating, that if they wanted to reach out to you, how would you propose that they do that?
So I'm very active on Twitter. So, you know, John_Frankel is a good way to reach me.
Yeah.
LinkedIn somewhat, but I get too many incoming requests. Yeah, I mean, network if you can. Warm interest. It's kind of interesting. We do accept sort of cold calls and that kind of stuff. But in reality, warm intros are where most of the companies we've ended up investing going in, without that being the intent. And I think every VC will say that. So find a way to network, find a way to make something happen. Sure. The initiative of that itself, you know, and look, within our firm, we got 18 people. So you got 18 sets of LinkedIn people to navigate through or whatever. Yeah,
sure. Or I can, you know, I can talk to them and perhaps talk about an introduction as well.
Yeah, or ping Twitter or whatever it might be. That's probably the best way in.
Okay. Well, this is going to be going out to, you know, to the Rekall Consulting LinkedIn followers that we have, which is approaching 30,000. So hopefully, you know, there'll be quite a lot of people that will receive your message at a time when I think people are looking for these kinds of messages. So I think it's perhaps good timing. And look, I want to thank you for your time. We've run over already, and I did think we could talk for hours about this topic, but you know, I really thank you for sharing some time with me, and I look forward to putting this out there and getting some good reactions from the community, and hopefully putting some new unreasonable people your way.
And you know, once again, you know, I think Founder Suite could be very useful to people. Maybe you'll get Nathan on at some point. He's got a great story to tell.
It'd be great to talk to Nathan. You know, again, somebody I can plug into a lot of people that I know back in my community as well. So, again, look, John, I appreciate your time very much. I'm going to let you get on with your day, and I look forward to speaking to you again very, very soon.
Thank you.
Wonderful. Take care.
Take care.
Bye.